Dow closing at a record high, and the market rotation seems to be gaining some momentum. For more on that, also earnings, let's bring in John Mowrey, CIO and Senior Portfolio Manager at NFJ Investment Group. And maybe everyone's getting a little ahead of themselves, John, but there is something we keep hearing Trump trade on people's lips. It's a long way to go, but do you see evidence of some action in the market that reflects an expectation that Trump will win, or that there might even be a sweep in Congress? Do you see that yet?
Well, there's definitely a lot of things coalescing in favor of Trump right now, not to mention, obviously, the events over the weekend, which have just further bolstered him, but then also with, Biden's debate performance. So those things are obviously, coalescing. And then plus, on top of that, what you had is actually a negative month-over-month CPI print, pulling it down to 3%, although further pushing Powell to look to cut rates. So all those things are shaping up for a really interesting dynamic. And on top of that, Joe, you've got the small and mid-cap bank stocks and larger bank stocks to some degree trading at some of the deepest discounts, going back in some cases to the tech bubble in 2000. So all those things are setting up for a very interesting rally, and we saw the beginning of that potentially start last week.
You think even if it's not a clean sweep, I mean, gridlock is probably positive as well, and that seems like that might be the base case as well in the Senate and House.
I think that is the base case. I think gridlock is welcomed by the markets, and they want clarity. And obviously, with the VP pick yesterday, the markets got more clarity on the direction that Trump is going, and he clearly is making age, vitality, youth part of the debate and further pushing that forward. So I think that's going to be interesting to see how that plays out. But no doubt, Joe, Trump has made it pretty clear that he wants lower rates. He wants to be friendly to the market. He wants to be friendly to certain sectors. And then Powell also has made it clear that he wants to lower rates. I mean, the U.S. has some of the highest rates in the world. You got to go to Latin America to find higher interest rates. And if you look at what the bond market's been telling the Fed, particularly since May of actually 2023, the two-year yield has been below consistently the Fed funds rate. And even though you might have been late to raise rates, it doesn't give you the ability to be late on this side as well. So Powell is clearly getting worried, and I think investors should act accordingly. And, one thing I'll share, Joe, which is fascinating, I sent this over to your producers before the show, the S&P regional bank sub-industry is now beating the S&P 500 by 400 basis points over the last year. And that's pretty impressive, given that you don't have NVIDIA, Microsoft, Apple, you don't have those FANG stocks in that regional bank sub-industry. And that's barely a move off the bottom relative to where it could go if you see a steepening yield curve and if you see those NIMs expand, which is very plausible under the next president.
Even though rates may go up based on inflation expectations, the steepening of the yield curve is good for that sector, is what you're saying.
Yeah, no doubt. I mean, I think that rates could on the long end drift a little bit higher depending on inflation. But the reality is all the numbers are pointing to inflation should go lower. I mean, if you strip out housing, you've got the CPI sitting there at 2.2. And the reading here at 3%, Joe, is pretty favorable historically. I mean, the 10-year average is 2.6. So you're right there in line. And, what I would say is that, when you think about inflation, that's obviously a very regressive tax on the U.S. consumer. But interest rates being high is also a regressive tax on the U.S. consumer because more people's disposable income is being pushed to interest expense, and that's disproportionately impacting the bottom half of the U.S. consumer. So I think that the Congress, Powell, the president are all going to have an interest in lowering rates if they can. And inflation seems to be providing a window for them to do that. And the other thing I'll say about Trump is he also, if elected, probably wants to see the trade deficit narrow. One way to do that is with a weaker dollar. One way to get the dollar weaker would be to lower rates.
Perversely, sometimes if you remove regulations and drill, there's more supply. That could mean, and it'd be good for everybody for lower oil prices, but not necessarily good for the energy stocks themselves. They actually might not flourish if you really ramp up production or remove any obstacles to increasing production.
Yeah, I worry about that a little bit, to be honest. It kind of reminds me of whether it's energy or whether it's, some of the ammunition stocks, depending on who gets in office. Even if they're pro or against certain policies, that can have unintended consequences. So I think with less regulation, Joe, it is very plausible that we could see higher production. That's good for the U.S. consumer. That's good for inflation. But it may not be good for some of the profits with some of the bigger oil companies. Valuations there are, I would say average. So they're not, extremely cheap. They come off very low levels when oil dipped negative. So there is value out there, but I do not think that energy is probably the most attractive area within the value space if you were looking to allocate capital.